Hi everyone, this week we've got Mark on the show. We're going to be talking about analysis, how can you use finance and enhancing technology for landlords and property investors. So Mark, before we do anything, I want a quick introduction from you, please, as to who you are and what you've been up to.
Yeah, sure. Hi Lee, thanks for bringing me on the show. So basically my background is finance. I'm a mortgage intermediary working with property owners and landlords, usually with large complex portfolios. And we're also working on a platform, a software platform for property landlords and investors to help enhance their analysis on transactions.
Wicked. So this is a topic that everybody wants to know right now. So let's talk about the data. So how's the analysis changed in the last 6 months?
I don't think that necessarily the analysis itself has changed in the last 6 months, but the outcomes are clearly different, and that's been driven predominantly by the cost of finance and how that impacts it in a transaction. We've been in a period of historically low interest rates, so deals have stacked very nicely, but now obviously that has been challenged as the interest rates have gone up. Deals that worked possibly 6 months ago don't work today. That's a fact. I think we could probably go back to deal stacking and what is deal stacking, and I think it's different for everybody. And a lot of conversations that I have are around does this deal work? And people tend to be asking me questions around trends. What am I seeing in HMOs? Sort of yield figures, that sort of thing. But I think that conversation is quite individual to you as the property investor. Your set of circumstances will be very, very different to that of another. And what you're trying to achieve out of property may be very different for someone else. So that analysis needs to be quite individual and quite bespoke. And that's something I think that the software can really help with. A spreadsheet is great. It will spit out a number when you sort of punch in your purchase price, etc. But that doesn't necessarily give you context behind that yield and understanding as to whether that's good based on your particular set of circumstances. So in short, I don't think the analysis has changed. The outcomes are different. And of course, we're seeing now people having to leave more money in a transaction to make it work for mortgage purposes. But what that will ultimately mean is that people need to reflect back on purchase prices, build costs, and making sure that the end values are where they need to be and that they haven't over-leveraged themselves through the process.
Yep. No, I appreciate that, Mark. And I kind of want to ask you a bit more on the financial side of things. And, what you're saying, what do you think the main things to consider are when analysing the part, like the deal?
Yeah, so there's quite a few things. There's two camps really that I see that really need to be considered. So you've got the financial consideration, which everybody knows, or most people don't understand because it is an investment, so it needs to work commercially. So those are understanding your yield, your profit on cost, all the various metrics and ratios that get considered when you're looking at a transaction of that nature. But I think a lot of consideration also needs to be given to the non-financial aspect of property investing, and that is your time. So it's managing legislation. What are your obligations as a property landlord to make sure that you are legally compliant? How much time is that going to take? If you're going to go down the route of high cash flow strategies such as HMOs or short-term lets, have you considered the level of time that will need to manage that strategy on those sorts of components? So if you are sort of getting a single figure yield of 8 or 9% on a property, considering how much time and effort has got to be utilized to maintain that yield, and is that worth the effort going into it? Again, it all comes back down to individual circumstances. If you have a job, say this is a part-time thing, and this is more of an investment than a full-time job, your hourly rate may be 40, 50, 60 pounds an hour. How many hours are you spending on your property portfolio to maintain it, and has that been taken into consideration as well? I don't think people necessarily value or account for the hours spent in managing the portfolio. So I think there are two schools of thought. Definitely the financials, and people are very acutely aware of that. But I also think it's the non-financial piece that needs to be considered, and is an investment worth it, given the amount of time that you may need to be spending on it for the level of return that you're ultimately getting back.
Yeah, no, I agree with that. And so when do you think finance does fit?
Finance is a relatively large component of property investing. It's an asset that can be leveraged fairly easily in comparison to other asset classes that are out there. So it definitely does fit. I think it depends really on the type of investor that you are. If you are, say, for example, an accidental landlord, you may have inherited a property, then finance may not play a part because it may be an unencumbered asset and so on and so forth. So again, we come down to individual set of circumstances. I think it's widely accepted that if you look to grow a portfolio, leverage is the key to accelerating that growth. If you're going to just sit back and wait for the net returns to accumulate and put into another deposit, and that's something that's going to take a lot longer. Finance is key, depending on the type of finance that you want to use. Is that bridging finance? Is that development type finance? If you've got projects, if you're looking to add value to a property, the buy, refurbish, refinance strategy, again, is one that is pushed really hard. That's a great way of growing a portfolio quickly. Finance and how it sits in it, clearly you're going to have finance for a long time. So therefore, you need to understand the long-term implications for that finance also, and making sure that you do adequate stress testing. A question that I get asked a lot is, what percentage rate should I be stress testing at? Well, clearly that answer would be very different to 9 months ago, where the interest rates were arguably, they were a lot lower. My answer to that is usually don't stress test with a specific number, keep stress testing it until it falls over, until you can't afford it anymore. That will tell you the point at which the transaction doesn't work anymore. So rather than concentrating on an arbitrary number of, say, 6 or 7%, you want to be pushing it as hard as you can to realize at what point this ceases to make money. And that is the point at which you need to really start to ring the alarm bells. And there's only certain factors that you can do. You can reduce your outgoings if you've got an all-inclusive HMO, for example. You can increase your rents, or you can pay down your debt. Those are fundamentally the levers you can pull to try and manage that process as strongly as possible.
Wicked. I think that that advice there is of stress testing to the point is something probably people don't think about that much before they go into it, and I think that's a great piece of advice. My last question for you, I want to ask you about technology, and how do you think that landlords and investors can use that?
I think technology or prop tech, fintech, whichever camp it falls into, is a great tool, and it's a growing space as well. We're coming into that space as well. There are many competitors sort of trying to solve the similar sort of problem for property landlords and investors. I think what it does is it drives efficiencies. So rather than, and it gives you the time back. So we understand that analysis can happen. It's how quickly and efficiently you can undertake that analysis. And a lot of software focuses on the actual purchasing of the property, whereas what we're looking to do is also manage and maintain the ongoing monitoring compliance-wise and the stress testing, understanding the performance of the property and benchmarking that against national and regional trends, which is what a lot of the conversations that we have. So I think having that knowledge and understanding as to how is my portfolio performing, how is it performing against other similar portfolios in the area? Am I achieving best-in-class returns, or am I actually underperforming? Again, that's an individual take as well as taking the bench as to what you're trying to achieve. But I think the ability to aggregate all of that data into one location and just make it super easy for people to get that information just ups their level of knowledge on their particular portfolio, and ultimately means that they can enhance their returns where they need to as quickly as possible, almost becoming like a business analyst level of understanding of investment over and above what they're doing currently.
No, I think technology massively drives efficiencies. It really does, and it makes things easier for your life in terms of putting things where you need them to be, putting things in place, having systems, having technology to help you with that. It's a huge advantage. So, Mark, thank you so much for coming on the show, and thank you for all your advice. I really, really appreciate it.
Yeah, you're very welcome. Thank you.